Hi, everyone. Thanks for joining us today. My name is Allison Dwyer, and I'm the Marketing Specialist at CQG. Today, we will be learning about the benefits of Rcm-X Algo strategies, which are available in CQG Integrated Client and CQG QTrader. Today, presenting, we have Jim Stavros from CQG and Joe Signorelli from Rcm-X. Jim started with CQG in 2005 and is currently a part of our product specialist team. Here at CQG, he specializes in custom studies, conditions, and trade systems for use in CQG products. He's also an expert in Microsoft Excel-based RTD. Jim is a veteran trader for many plus years and a member of CME, where he specializes in trading a variety of commodities. We also have Joe Signorelli, who's the founder and managing partner of Rcm-X. Prior to forming Rcm-X, Joe served as the head of futures for Wedbush, as well as a member of the board of directors for Lime Brokerage. He has also held positions in the past, including co-founder and CEO of Cactus Trading Systems, managing director of the Quaint Stat Trading Group, and partner and director at Stafford Trading. He currently sits on the University of Illinois and UCLA's MSFE boards and has held memberships at the CME, CBOT, Chicago Stock Exchange, and Minnesota Grain Exchange. If you have any questions during the webinar, please make sure to enter them into the Q&A window off to the right-hand side, and we will answer them at the end of the presentation. Starting us off today will be Joe with Rcm-X. So, Joe, would you like to tell us a little bit more about Rcm-X?
Sure, I will, and thank you, Allison, for the introduction, and thank you, everyone, for joining us today. We appreciate you taking time out to hear about the Algos and hear how we're integrating these Algos within CQG. With me also today is David Don. He's our CIO and head of algorithmic trading. He'll be going through many of the technical aspects of the Algos and parameter settings. Let me tell you first a little bit about RCM Alternatives. RCM is a boutique investment firm bridging the gap between fintech and high touch, merging new technology with industry veterans to help trading firms reach their potential in terms of alpha generation, capital raising, and operational efficiency. And then a little bit more about Rcm-X, which is a division under RCM. It's a multidimensional financial technology firm, and we also provide, obviously, execution algos for equities and also futures and custom algos. We have a division for risk management, for consulting for hedge funds, mutual funds, and third-party asset managers. We also have our Strategy Studio proprietary technology under RCM, which is licensed to high-volume, low-latency systematic traders across asset classes. So that's pretty much our firm and our division within the firm. So firstly, when we look at, before David gets into the algos themselves, we kind of believe, or we believe algos level the playing field. According to the CFTC report, automated trading systems make up nearly 70% of all trading in the futures markets. And then secondly, algorithms are designed to increase your execution quality by benefiting from the speed and technology they're built on. Thirdly, algorithms minimize your trade impact on markets using embedded logic while still allowing opportunity and cost and capture. Execution algorithms are able to dynamically interact with the exchange order books to lessen the inherent advantage of the automated trading strategies. So leveling the playing field by being able to interact with the order books at the exchanges is a key part of algos, and our systems and our technology allow you to do that. So I'm going to let David now take it and kind of go over some of the cost impact numbers.
So when thinking about why you might use an execution algorithm, one thing to think about is the cost of trading and its impact on your strategy's returns. And so this is a simple calculation here that we've made on a bunch of popularly traded products and what their tick size is, and if you're running a CTA that has a certain amount of turnover, in this example, if you're doing 2,500 round turns per million, that is an easy calculation to imply the average annual cost from crossing the spread. And as you can see with these numbers, that actually digs into your returns in a material way, costing you from a couple percent to over 6% on an annualized returns basis. And for a higher turnover sort of CTAs, these numbers can be pretty conservative. That you might have higher round turns per million, and you may also have order sizes where you're not just crossing the spread and taking the liquidity you see on the opposite side of the book, but you might even be incurring market impact and burning through the book or pushing where the market goes as they're reacting to your order flow. And the idea of an execution algorithm is essentially to minimize your slippage or track a benchmark given your preferences for how sensitive you are to executing quickly versus spreading out your order. And I'll turn it back to Joe for more.
Yeah, so why use our algos? This is where we think we differentiate from the competitors. Our algos are built by traders. Everyone on our team has had pretty decent experience in trading, whether it's been market making, whether it's been stat arb, whether it's been on option trading or futures trading. So we have a vast amount of experience on trading. So that's one of the things we believe is one of our competitive edges. Optimizing your trading, we believe that let us do the heavy lifting. We know the microstructure of the market, and by embedding these algos in CQG's system, we believe that you should focus on the alpha, and the trader should focus on what their trade is, and it's tough enough to find those trades, and count on the algorithms to do the lifting and do the execution. Our Strategy Studio platform, we believe, is another competitive edge and why you should use our algos. Our platform is 10 years of development. The stack of technology is very microstructure aware. It's embedded, and we understand the order books very well, and whether it's equities or futures, and it's a key component and one of the main components in delivering quality executions. Custom. We also, because of our platform and our experience, we have the ability to customize algos, and not just, we deliver our 7 benchmark algos, which are pretty much, should be sufficient for most clients, but because of our experience and understanding that some clients may need something specific, it's not going to take months for us to turn around a custom algo. We can usually do it in a few weeks with our platform. David, why don't you go through Strategy Studio?
Yeah, so we wanted to talk a little bit about the technology that we build the algorithms on. This is a technology suite called Strategy Studio, and we've been licensing it out for the past 10 years to high-frequency traders, low-latency traders, clients doing things like liquidity provision or intraday stat arb, event-based trading, basically strategies that trade in a black box fashion and are sensitive to latency. And the stack is written in native C++. We do in-process feed handling, and the event processing platform has very low latency, so we're able to keep up with the market data well and not fall behind on where we see the prices in the market, which is very important for getting good fills. Oftentimes, clients have an attitude that high-frequency traders, speed is critical to them, but if you have a big order and you're just trying to carve it out over the course of the day, speed is less important. And we think that that view is misguided because even if you're spreading out an order over the course of the day, you're still trying to optimize when you place child orders, what price you put on your limits for the child orders, and those decisions, if you're slow to reach the market, if you're slow to process the market data, you miss your fills, and you have to subsequently chase your fills at inferior prices. So speed helps even if you're working a big order slowly. This technology is also cross-asset class, data vendor neutral. It has a built-in simulator, and you use the same strategy code across the cycle of back testing, simulating against live market data, and trading in production, so that you're using the same code live as you've been using in your research and development. That minimizes your risk of taking strategies into production, and it also helps you continuously improve the strategies by monitoring the simulated performance to the live performance. And then as you tweak the strategy, you can rerun them in back tests, keep them simulated against the live trades, and see how the changes are impacting the results. And the software gives us a lot of easy abilities to add new parameters and tweak strategies live while they're running. And it, because it's a mature API that was built to be trader-friendly, it greatly minimizes our time to market for changing algos and bringing new algos to production.
So David's going to go over a little bit about the microstructure and why it matters and go through some of the CME's matching components, and why don't you go through some of the...
Yeah, so when you think about execution algorithms and the complexities that they face, besides being fast, another important ingredient is being sensitive to the markets that you're trading. Different markets have different complexities. When we develop equity algorithms, we have to pay attention to the fact that in the U.S. markets, there's a dozen exchanges and 30 dark pools where we can seek fills on. In the futures market, we face a different complexity in that each product trades differently and has different characteristics in terms of when they're active and how they behave across the expiry cycle, how monthly contracts behave versus quarterly contracts. And so all of our execution algorithms are designed to take these nuances into account and pay attention to which matching engine the product is trading on. So if a product is trading with a pro rata matching engine at CME, we'd be more likely to place, say, bigger child orders when we're attempting to get passive fills. And our forecasts for the volatility and volumes are all product-specific and modeled for each product. And our team has extensive experience developing strategies for futures products and strategies like market-making algorithms and grains and short-term interest spreads where, sizing orders to get good fills on pro rata and leveling allocations is a key ingredient to success. And we'd also like to talk about what the actual standard algorithms are and what they do and why and when you would use each one of them. So many of these names, if you've used Algos before, should look familiar. From the top, we have a VWAP strategy, and the VWAP strategy aims to track VWAP benchmarks, so that's the volume-weighted average price. And it does that by constructing a volume forecast based on historical data. So we look at what time of the day different amounts of contracts trade at, averages of that over time, and then we adjust that based on seasonality for where in the expiry cycle we are. And we do those forecasts both for outright contracts and for spread contracts, exchange-traded calendar spreads. And essentially what the algorithm does is it builds a pre-trade schedule and releases child order quantity according to that schedule to stay in line with those historical averages. And so the aim there is to track VWAP, and that strategy, because it's maximally spread out according to where volume trades, if you expect your slippage to be impacted mainly by how fast you're trading, because this is at all points trading as slowly as it can, it's also, in that sense, the minimal market impact strategy. And it's best used for products that are liquid in the sense that their historical volume information is going to be a good predictor of current day's trading activity, and where you have time to work your order over several minutes to the entire day. And these strategies are all designed to spend some time working passively to achieve passive fills and not just cross the spread. As you'll see in a bit, we also have parameters that let you kind of tune your preference for things like how often you'd like to cross the spread to stay in line. The strategies also employ anti-gaming techniques so that there's a randomized element to how we react to market conditions and how we size our child orders to minimize our predictability and footprint to our contra trading participants. And the TWAP algorithm is, in a sense, a simpler version of VWAP. Rather than scheduling based on historical volume patterns, it's just an even schedule over time. And TWAP is, more predictable on when it's going to trade because you just know it's going to trade evenly, and it can be a valuable alternative to VWAP if you're trading in a liquid product where the historical volumes may not be a good predictor of today's activity. POV is percentage of volume, so that rather than trading based on historical volume patterns, it releases child orders as today's trade volume unfolds. And so it attempts to participate in a specified participation rate against today's market volume. The advantage of that, again, is that it is trading based on today's information rather than a forecast based on history, so you're always trading based on what the market's actually doing. The disadvantage of that is because it's not allowed to plan ahead of time. It's always essentially playing catch-up to what's happening in the market. And scale POV is a variation of POV that lets you reflect an opinion on whether you think the market's prices are going to exhibit trending or reversionary behavior. What it does is it lets you set a band on your participation rate. So rather than saying participate in 3% of the market's volume, you could say participate somewhere between 0.5% and 3% of the market's volume, and choose somewhere in that range depending on how far the price has drifted from the arrival price of the order. And parameters allow you to choose how strongly you wish to follow that alteration between that minimum and maximum participation rate. Implementation shortfall, or IS, is an arrival price algorithm, and what it does is it shifts more of the execution towards the start time of the order, and it does that by tilting the VWAP schedule. So it looks at the historical VWAP patterns, looks at that normal VWAP schedule, and tilts more of it towards the start time of the order. And the reason for doing that is to shift more of your execution towards your decision time prices. But again, if you believe that trading faster means higher market impact because you're trading faster near the open, on average you may expect to have higher market impact with this order, but at the benefit of more certainty in execution price. When you spread things out entirely according to VWAP, the market can drift from where you're making your decisions. Sometimes that'll go in your favor, sometimes it'll go against you, but if you're averse to that risk, using implementation shortfall can help you control that risk. And an aggression setting lets you choose the trade-off between how fast to trade at the start of the order versus how much to spread it out. The close algorithm is essentially a mirror image of the implementation shortfall algorithm. It shifts more of the execution towards the end time of the order. And the reason you might want to consider that algorithm would be if you're exiting a position and you want to hold your exposure for a longer period of time on average, so you do more of the execution towards the end time of your order. The other time to use that would be if your performance is benchmarked to, say, end-of-day prices, and you want to execute most of your trade near the settlement or near the cash close of the product. Unlike the previous algorithms we've discussed, we also have an iceberg algorithm, which rather than trying to follow a benchmark like an arrival price or a volume-weighted average price or a percentage of volume, it sends orders with randomized sizes to minimize your footprint when you're just trying to get an order done. And so the iceberg is a randomized iceberg. If your limit price is passive, it'll send out a passive child order with a quantity somewhere between a min show and a max show setting that you set. And when that order fills, it sends out another one. If your order is marketable, it will go through and send an IOC order to take the liquidity it can see in the market data. But you can also specify a passive price level parameter if you prefer pegging behavior. And in that case, we'll always peg to a specified level in the order book. And we want to take a little bit of time to go over more detail some of the parameters that you're able to set for these algorithms. And we discussed some of them casually on the previous slide, but just to go over some of the ones we didn't hit on. For every algo, you can specify a start time and an end time. And so for the benchmark algorithms like VWAP and TWAP and close and IS, the algorithm divides your total quantity from the start time to the end time based on the scheduled percentages. And for algorithms like POV and iceberg, which just try to get as much done as they can over time, the order will give up once end time is reached. An I would price is available on the benchmark algorithms, and it's a price where you say if the market reaches this price, it's a really great price, just try to fill as much as you can at that price and start ignoring the schedule, just get as much done as possible. And so, for instance, if you're trying to buy the S&P Mini and price is around 2,300 and you say, hey, if the price falls to 2,200, that's a really great price to buy it, just get as much of the order done as possible. So the I would price lets you enter that preference. The maximum participation rate is a key parameter for the percentage of volume strategy, but it's also an optional parameter for a bunch of the other benchmark strategies that can act as a constraint. So if you have a really big order and you specify VWAP and you start working it at the start of the day where the market's very active and we schedule a lot to execute at that time, but that quantity is exceeding a POV constraint, we'll hold back to honor that constraint. And the POV strategy, we mentioned that one of its drawbacks is it's playing catch-up with the market data, and that it's allowed to trade quantity based on the amount of volume it's seen in the market data. One way to help minimize the negative consequences of playing catch-up with the market is to set a block limit setting. And what this does is it says if we see a trade print in the market data above this size, we'll ignore it for the sake of calculating the volume participation rate. And so that way, if there's a big print for, say, 10,000 contracts, and you have a 5% participation rate set, rather than being able to trade an extra 500 right away, it'll ignore that big print, and so it'll hold back on immediately trying to get that 500 done. The tracking parameter is a parameter that you use in scale POV to specify whether you think that the prices are going to be trending or reverting, and that's how we choose to set the participation rate on a dynamic basis between the minimum participation rate and the maximum participation rate. And the final three parameters are parameters we already discussed when explaining what the iceberg algorithm does.
So now what we'd like to do is David we'll go through some of the products that are on the CME now, and then let Jim go into some examples, some live examples. So.
Yeah, so currently we're up and running with the list you see on the screen in terms of product coverage, and these are essentially liquid CME products on the whole variety of Algos exchanges, and we support both the outrights and the calendar spreads. And we do release support for the algorithms on a product-by-product basis, since we do go product by product to model patterns in volume and volatility and matching engine characteristics. And over time, we're going to be releasing the algos for a wider variety of exchanges.
I'll show you how to execute this in CQG. It's pretty easy. So I set up a page. Here I have, let's say, nat gas, and I've already put some orders in, but I'll show you how you put an order in. So you simply choose from this drop-down list which of the algos that you want to try. In this case, I chose the percent of volume. And you can set it up so it's default as well, and I'll show you where that is here under the setup. If you go under the trading preferences, we actually have a section here where you can go into the algo orders, and you can set each one up individually. So if you wanted them to have some sort of default in them, like in case of percent of volume, I've set a 5% participation rate by default. You can do that. So you can set it up by default, and each one of these has its own setup. But you can always set it up on the fly right from here. So again, I'll choose percent of volume, and let's say I wanted to go ahead and I'm long 24 and I'm working 26. If I wanted to work to do 25 more, right, I could go ahead and say buy 25 more at the market, or I could place a limit order in there, but I'll buy 25 at the market. This box pops up. It's my confirmation box, and from here I can choose what we said, all the parameters that we went through, and I can choose my start time and end time. In this case, I'm just going to enter an end time, so I'll just put it for a few minutes out and place the order, and I accidentally made a mistake, of course. Whoops. Two mistakes now. All right, can't go past this. Let's see, what time is it now? It's 3:24, so put this at 15. Okay, so now I'm working this many contracts. I can now put this into what we call our cost analysis studies, so I can see how I've been doing. And we do have a quote board up here, and from the quote board you can see all of the things that are available up here. There's actually a whole bunch of studies that are available. If you go here and into our studies, we have a tab here that says Algo Order Analytics. And from here you can, if you want some information on what all these are, for instance, if you want to see what was the TWAP over the time that you've been executing the price, what was the VWAP over the time you've been executing the price, All these things are available. Your fills, it'll show you as you've been getting filled. It'll show you your participation rate according to the market volume. What's your fractional daily volume? If you don't know what some of these mean, like some of them are a little more complex, like figuring out your internal return in basis points, you can come down here and you can go into the info, and we'll give you additional info on that particular item. Okay, and here's all the stuff that we have info on. Okay, so that's found under Studies and under Algo Analytics. So for here, one of the things you could do, if you wanted to find your fills, right, you could actually go to one of the orders that's being worked on, right? This one's working. I can actually left-click and hold the left-click down on that order, and I can drag it down and drop it into my, right into my study. So that'll tell me where my fills are, if I have any fills in this market, which I have a couple of fills here, 24 fills. If I pull in the sooner one, let's take this one, drag that one in. That one should show me the fills from earlier. That one's still working? Oh, this is the one that's working. Sorry, you have to take the right order in, obviously. But so then here, I'll be able to see where my other fills are. Let's see. Scroll back. Here they are. So as you hover over, you're able to see what was filled there. You got to fill here. You got to fill here. You can see your total quantities up here as well. You can actually, as a kind of a shortcut, if you wanted to see any of these quickly, you can, click on, let's say, fractional daily volume. You can click on this. It'll open up a chart, 5-minute, and you can actually see your study down on the chart. And that tells you what you are over this time period since I put the order in, how much of the volume I was on a daily basis, which, since it's only 25 contracts, you would expect it's going to be super low, and it is super low. You can also figure out if you wanted to see something like your VWAP or TWAP, which I think are a little bit more interesting. You can do that. So you can go to your TWAP, click on that, and you can see what your TWAP was over the time period. So that's the TWAP, and you want to compare that to maybe your average fills or something. Go ahead and put your average fills on there, and you can see what your average fill price is. Sorry about that. Your average fill price is almost identical to what your TWAP was over that time period, mainly because the market's been going sideways, so it would be expected to be filled over the time in a flat market like that. Might not be the same if I'm looking at VWAP, which I could put that on as well. So here's my VWAP study, and the VWAP study is actually the same as well. So, I'm pretty much getting filled at the price that you would expect TWAP and VWAP in a flat market. That's how you use CQG and how you use the RCM algo orders. They're pretty interesting, and I think you'll find them useful. Turn it back over to you, Joe.
Sure. So, and that's pretty much our overview here. I think Allison's going to have it open up for questions, possibly. And
yeah, if anyone has questions, go ahead and put them in the Q&A. Okay, one of the questions we have is what sort of minimum order size do you believe is needed for Algos to give a benefit?
So that's an interesting question. When we design benchmark algorithms, we're really designing them around the anticipation of working a larger order and minimizing market impact. But we do often get clients that send flow for a very small clip size. Maybe they're just doing a few contracts or even one contract. And the benefit you might see in situations like that is certainly less because you have less to get done. But if your alternative is to send a market order, and cross the spread, it does give you an opportunity to spend some time working the order systematically to try to get passive fill before you take the step of crossing the spread. But it really depends on the turnover of your alpha signal while you're trading and the product and all that stuff.
Okay, and another question we have is there any support in the CQG IC API for this?
At the current time, we do have plans to put it into the API, but it is not ready just yet. But we figure that should be in the first quarter, by the end of the second quarter of this year.
And currently it's available on the integrated clients order entry tools as well as QTrader.
That's right.
How do we get access to the algos?
Yeah, so to get access to the algorithms, you'd contact RCM and the contact information in the invite.
We will have you guys reach out to your account representative at CQG if you do have any questions, or someone from Rcm-X.
Yes, and we do have Rcm-X, that's rcm-x.com, where you can find out more information.
Okay, our next question is, will the use of iceberg orders depend on the exchange being traded?
Yeah, so the iceberg algos are supported across products, and it doesn't leverage the exchange native iceberg, so we manage sending out each new child order as the previous one is filled, so it works even if the exchange doesn't have a native iceberg order type for the product.
Okay, and do these algos work for options? If not, is it coming soon?
Yeah, currently we support the outrights and the calendar spreads, and we are looking at adding options execution algorithms later this year.
If somebody wants an individual, demo of this product, I'm happy to do that. You can call CQG 1-800-525-1085, and I'll go through it with you individually, maybe the ones you may be more interested in.
Okay, another question we have is, are there strategies like pairs trade, implied volume-based option strategies available as well?
Yes, so the option strategies are something we're looking to add later this year.
Okay, another question, is the algo separate platform or is it integrated IC?
Yeah, so I think the question is about where the algos are run, and while you enter the parent order on integrated client or QTrader, the algo logic itself resides in the Strategy Studio technology stack on a co-located server, and so all of the child order logic is made server side.
Okay, and what are the most often used on the list of algos?
Yeah, so I think the most often used algo is probably VWAP. I think VWAP is something that's very familiar to most traders. Iceberg is also popular, and I think that, over time it's good for traders to consider using IS as an alternative to VWAP, because it does give you more flexibility in terms of how fast you want to execute. And the aggression parameter on the IS gives you control over how fast versus VWAP. So if you do tend to like slower execution with less market impact, you can always use the IS algo and specify an aggression of 0 versus the default aggression, which would be 5, or the maximum tilt, which would be an aggression of 10, and you can choose along that spectrum from 0 to 10.
Okay.
Sure.
Our next question is, what is a parent order?
Yeah, I maybe should have clarified that. So parent order is essentially the VWAP order. And so when we think about how an execution algorithm works, the algo engine receives a big order to trade, say, like 100 contracts, 1,000 contracts, 10,000 contracts, whatever it happens to be, and we call that the parent order. And the way we execute that is by sending smaller orders over the course of time, and we refer to that as child orders.
Okay, and do you have any algos specific to illiquid markets?
So for illiquid markets, oftentimes we see TWAP being popular because it's not looking at the historical volume, which might not be a reliable guide to what's going on today. And also Iceberg can be popular for that. And we have worked also with clients to develop custom algorithms tailored to illiquid products.
Okay, our next question is, how can we build custom strategies using the platform?
So for the pre-canned execution algorithms, those are strategies that are built by us, and we can customize them and build custom algos, but those are always execution algorithms where you send us, again, what we call parent order, and we work the child orders for you. That being said, the technology that we use to build the algos, we also license out as a software license to firms looking to build black box automated strategies.
Okay, can you clarify on whether this, the algos were developed by RCM or if they come built in CQG with RCM able to tinker with the base ones to adapt them to our liking?
Yeah, so all of the technology that the algos run on and the algorithms themselves are built by the team at Rcm-X, and we've integrated with CQG to provide easy access from their order entry interfaces. And CQG's also built out some nice tools that you saw during the demo today for transaction cost analysis.
I think we are about at time for questions. So if you guys do have any other questions, please make sure you reach out to Rcm-X or CQG. If you did miss anything during today's webinar, you can view a recording on CQG's YouTube page, and it will be sent out via email. And then, like I said, for follow-up questions, go ahead and contact Rcm-X or CQG. I do want to thank Jim from CQG and Rcm-X for being here today and presenting. Do you guys have any closing remarks?
No, we just appreciate everyone's time today, and please reach out if you have any more questions or you'd like to get more involved in the Algos.
Okay. Thanks, everyone.